Hi guys, let's look at this question. Traco, you can take 1 or 2 minutes, pause the video, just read through the questions and I'm going to solve it right away. Okay, so I believe you've gone through the question. The requirement wants us to calculate the theoretical extra price, likewise the impact of the new finance on the WACC for the company, and as a director's view that we are expected to discuss for part C. But let's look at the theoretical extra price, which is the first part of the question. That's what I want to solve first. And remember when we looked at this under the earlier videos, I gave you a simple method to crack this particular concept of calculating theoretical extra price. It's pretty straightforward. The first thing for you is to understand what is the ratio of the right issue. And if you look at this question, currently we have 150 million shares. Yeah, that is the number of shares that we have. So how many right issues that we want to issue, we need to find out before we can get the... So currently we have 150. And how many shares do we want to issue as part of right? We need to calculate that. So that is what we want to do quickly. So let's do that and find out. So what right issue would be? They said they want to finance $200 million. Yeah, and this 200 million, 50% will be debt. So we expect the balance of 50% to be the right issue. That's 50% of 200 million, right? So that's 100 million. So 100 million will be right issue. If 100 million is going to be right issue, yeah, then that means we need to know how many shares will give us that $100 million. So $100 million will be right issue, right? But one thing that we know for sure is we know the price at which the right will be issued, because they said the right will be issued at 20% discount of the market price, and the market price is currently $7. So that even makes life super easy for us, because now we know that the price, so the price of the right will be equals to at 28% discount, so that will be 100% minus 28%. Yeah, that will be the price times 7. Yeah, so this right will be issued at 5.04. Yeah, however, if we decide to just issue this number of shares that will give us 100 million, we'll run into trouble, because we're not going to make $100 million exactly. Why? Because the question also told us that there will be a cost. Yeah, so we need to incur, it's mentioned somewhere in the question that the right issue will be made at a discount of 28% to the current share price and will incur issue cost of $0.8 million. So which means that we need $0.8 million as well, right? So yes, we need $100 million for financing, but at the same time, we also need $0.8 million to cover the cost of issue. So which means the total money that we need to make this right issue successful is 100.8. So the number of shares, in order to achieve that total amount, will be equals to this 100.8 divided by the price of issue. So which means we need 20 million shares. This means a million. So we need 20 million shares in order for us to be able to achieve that lump sum of money. Yeah. So if we need 20 million shares and we currently have 150 million, so we can know what the ratio will be. So this question mark is now 20. Now we know what it is. And that is ratio, let's see, what ratio is that? That's 7.5 to 1. That's ratio 7.5 to 1. So now we can calculate theoretical extra price, because we know that for every 7.5 million shares you have, you get 1 share. And that one share, you will buy it at 5.04. The old 7.5 million is valued at 7. So which means we get the total valuation of that ratio. That's for that. And for the new one, that multiplied by 1. Yeah, so the total amount will be this plus this for that ratio. And the number of shares is this plus that. So the weighted average price is this divided by that. So just the same way we did it, and try to stay consistent, remember, with whatever we're doing. Yeah. So that is the theoretical extra price is 6.77. And that is part A of the question. With this, you have 4 marks. Yeah, remember what we've done? What we have done is we first got the ratio. We put the price for each number of the ratio. For 7.5, those are the old shares. We value them at the old price. And for the new right issue you will get, you value it at the right price. And if you value all the shares, you get 52.5 for the old ones and 5.04 for the new right issue. If you add them together, you have 57.54. And this 57.54 is for both 7.5 shares and 1 share, and that is total 8.5 shares. So for 1 share, that will be 57.54 divided by 8.5. And that's how we got the theoretical extra price of 6.77. Now we can look at the B part of the question. And the B part wants us to determine the impact of the new finance on the WACC. For us to talk about the impact, the first thing we need to talk about is what is the current WACC? You need to know the current WACC. When we know the current WACC, then we'll calculate the new WACC, then we can discuss the impact. So for current WACC, what the question has told us is that currently, this company is financed entirely by equity. And if that is the case, if you are 100% equity, then it means that your WACC is equals to cost of equity. So that means our WACC will be equals to KE. So it's KE that we'll just calculate for current WACC. And we know KE, we need to use the CAPM from the information we have here. We have this information here. So we have the risk-free rate at 4.5, market return at 12.2. And they've given us beta, the current beta, yeah, it's going to be asset beta because the company doesn't have any finance risk. So if you don't have financial risk, then your equity beta is the same as your asset beta of 1.35. However, after the debt issue, we expect that to change to 1.72. So we'll see how that will play here. But currently, there is no debt. So cost of equity will cost to RF plus beta into bracket the market return minus risk-free return. So this is what we need to use, and that will give us a KE that is equals to RF is 4.5%. Then we're going to add that to our beta of 1.35. That will multiply by RM of 12.2% minus 4.5%. And that will give us about 15% there. That's about 14.9%. Yeah, that is current WACC. Now we know the current WACC. The next step is to determine the proposed WACC, which is the WACC after the debt has been issued and the right issue has been made as well. Right. So I will start with the steps, which is to identify the capital available. Yeah. Here we only have 2 types of capital. We have equity, as well we have a debt that is about to be issued, and that is a convertible debt. So remember, once you know that, the next thing is to calculate the market value for each. So for equity, let's work that here. So market value of equity. Now remember that we have issue right issue. So which means before we had 150 million shares. 150 million equity shares. Now, if we do a right issue, we said we need to issue another 20 million. Yeah, 20 million share. So which means the market value of our equity after we've done that right issue will be total of 150 million share plus the 20 that we are issuing. Excuse me. 150. So that's the total number of shares that we have now. And immediately after we are done issuing, the shares will be valued at theoretical extra price. And that will be 6.77. So currently we have the market value of our equity. The next thing is to get the market value of the debt. So let's get the market value of debt. First of all, we need to know the price of debt and the number of debts. So we know that 100 million, if they are trying to issue 200 million shares, yeah, and 50% will be debt, then that means the debt is $100 million. Yeah, and to get the number of debts, we need to divide by 100. That's the face value of debt. Yeah, so that means 100 million divided by 100. So that should be 1 million. So 100, I think, and one more zero here. Yeah. So, yeah. So this is the number of debts that we need to issue, but we also need the price of that debt. So what is the price of that debt? Let's find out. They told us here. They said the directors want to raise half of the amount in form of a 4% loan note that will be issued at a discount of 2%. Yeah, face value is 100, and if you're going to be issuing at a discount of 2%, that means the price will be 98, because you will be giving a discount of 2% of 100, and that is $2, so that's $98. So the market value of debt will be equal to 98 of that price multiplied by the number of debt that we're trying to issue. So which means we have this. Let me make this absolute. Yeah, it's in millions, so that we can be comparing likes with likes. Yeah. Okay. So we know the market values now, so we can just put that here. That is market value of equity, and this is market value of debt. And we can sum that together. That is total. So the next step is to get a proportion. So percentage proportion. And for equity, that will be equals to this divided by the total. And for debt as well, that will be equals to this divided by the total. So if you want to check, everything must equals to 100. If it's not, then something is wrong. Yeah, one is 100%. Yeah. So we have our percentages for both of them. Now we need to get the cost of each of them, cost of capital. For equity, we need to calculate the cost of equity, and for debt, we need to calculate the cost of debt. So let's do for equity first, cost of capital. For equity, we know that things have changed because now we've issued debt. So cost of equity would have changed because of a beta that has also changed, but we're still going to use our CAPM formula, this formula here. This is still what we're going to use, though a few things would have changed. So but risk-free rate will remain the same because it's risk-free rate, 4.5%. However, our beta would have changed because we have issued debt. So that's why beta is now 1.72. As you can see, it's given here. And that will be multiplied by the market return, which will not change. That is 12.2% minus 4.5%. So cost of equity has changed to about 17.7%. Now we need to do the same thing for debt. We need to get the cost of debt. Here, because the type of debt that we're talking about is a convertible bond. So it means our cost of debt will have to be IRR. And I believe you still remember how to do IRR. This is about plotting the cash flow. So we need to plot our cash flow for this one. And the same way we normally do it, this bond, let's see, is going to be converted into 14 shares in 16 years. Or it can also be redeemed at 5% premium. So we need to do a test of conversion to know what is going to happen before we plot our cash flow. So let's do quickly a test of conversion. Let's find out if the investor will convert or not. So first of all, redemption value, how much is that? Redemption value is just 105 because it's 5% premium. So that is clear. We know that. Yeah. But what about conversion value? We know the conversion value. And conversion value will be the projected cash, that is talking about the projected price of the share times the number of shares that one bond will be converted into. Yeah, we know that one bond is 105 for redemption, but for conversion, what will be the market value of these shares? Remember, one bond can be converted into 14 shares. So, but for one share, what is the value? One thing we know for sure is that the question has made us understand that after the share price falls to theoretical extra price, it is then expected to go by 3%. So which means that would be conversion value will be equals to the 14 shares multiplied by the share price at that point. And the share price at that point will be the theoretical extra price that will grow for 6 years. So this price will grow for 6 years. And that means we need to multiply it by 1 plus growth rates of 3% raised to power 6 years. So that share price will grow like that. That's the share price that we're expecting. And that means that the conversion value is expected to be around 113. Now, looking at these two options, it is clear that a rational investor will rather convert because the value for conversion is more than the redemption. So now we can calculate our IRR and plot our cash flow because we've seen that conversion will take place and not redemption. So let me keep this a bit down so we can plot the cash flow. So we have the year here. I'm going to have the cash flow. I'm going to have the discount factor. Remember, we're going to need 2 discount factor. Yeah. Because we're going to do try and error twice for the IRR calculation. For year 0, the cash flow is minus 98, which is the price of the bond. From year 1 to 6, there will be coupon, and we expect that coupon year 1 to 6. They said the coupon for the bond is 4%. If the coupon is 4% and we know that the tax is payable at 25%, then that means that we will not get a total coupon because we have to pay tax on that coupon. So the coupon of 4, yes, however, we need to adjust for tax 1 minus T, and tax is 25%. So invariably, the net coupon we'll be getting is 3. And at year 6, conversion will take place. And that means we'll get that same amount that we decided, not the redemption amount this time, but the conversion amount. So we need to now do something quickly, and that is making a guess of two rates. And we can do 5 and 10%. So let's get discount factor at 5%. So that will give us some PV here. And we'll also get another discount factor, 10%. And that will also give us PV. Then we can calculate IRR. So if I go to the discounting table, the present value table, so we need year 0 for sure. We know it's going to be 1 for both of them. Year 0 is 1. But here I'm going to use annuity because it's year 1 to 6 and it's constant cash flow. So let's go to annuity table for the first one. So annuity table for 6 years. And at 5%. So that is 5.076. So that is 5.076. And for 10%, that'll be 4.355. 4.355. Then for the single cash flow at year 6, I need to use the present value table for that because it's single cash flow, not like cumulative cash flows like year 1 to 6 that you're having many cash flows. This is just one, so present value table will be used. At 5%, year 6, that is 0.705. So it's 5%, 0.746. 0.746, and at 10% that is 0.564. 0.564. Now we can calculate our PV, which is a discount factor multiplied by the cash flow. We can have our NPV. So NPV is 1.64 for that. For the second guess, that is this multiplied by the cash flow as well. And we can get the second NPV. So this is the second NPV. Now we can do IRR since we know that. I believe you still remember the formula for IRR, which is usually equals to the L, which is a lower, because I'm not sure you'll be given IRR formula in exams. I doubt. You need to know that formula. So lower rate plus NL divided by NL minus NH, then everything multiplied by H minus L. That is high rate minus lower rate. So if I put all those formulas together, lower rate is 5%. So that is 5% plus NL, that is the net present value at the lower rate, and that is this, divided by NL minus NH, this one, and that is the middle part of the formula. So with that, with the middle formula, then all of that, before we add it together, must be multiplied by 10% minus 5%. That is higher rate minus lower rate. And that should give us what our IRR should be. Like I always tell you, don't lump your formulas together like me. I've been using Excel for some time, right? What I always advise you to do is to break it down. Like let me show you how you can break it down if you're just learning Excel. Do L separately, the middle part of the formula separately, and the third part of the formula separately. So you know that L is 5%. That's the lower rate, right? Then the NL divided by NL minus NH. Do it separately. This NL divided by NL minus NH. You do it separately, and that will be equals to NL, which is this, divided by, open bracket, NL minus NH. This is your NH. Yeah. Put that one separately as well. Then H minus L. It's straightforward, and that's 10% minus 5%. Yeah. Once you have that, then you can do your IRR. Yeah. It's easier for you to work with this formula now that you have that breakdown, because that will now be equals to L plus, then open bracket. Remember, because you have to multiply this, multiply by the top part of the formula before you, this middle part of the formula, multiply by the third part of the formula, close bracket, and you have the same thing. So it will give you the same thing and makes life super easy for you. If you break it down, don't rush it, don't give yourself stress. Yeah, and avoid mistakes as much as possible, right? So that is IRR, which is the same thing as what we got here. You can see the same formula, the same answer. But I've just decided to show you a simpler way, especially if you're not very comfortable on Excel. So split it like this. Okay, so that is IRR. But remember, we have not finished the work. We've only done the most important part of the question, which is what will have the highest mark anyway. That's the reality. So we need to put our cost of capital in. So cost of equity, we got 17.7. And cost of debt is our IRR. We got that. And once we have that, WACC is easy. Now we can do WACC. Because WACC will just be multiplying the cost of debt by their proportion. And we'll add it together. Add it together. That will give us our WACC. Yeah. So WACC is 17%. Like 16.77% thereabout. So that's the new WACC, the proposed WACC. And that's what we've seen. So current WACC, let's look at the current WACC. Yeah, here. The current WACC is 14.9 and the proposed WACC is 16.77. The question says we should calculate the impact of the new finance on the WACC. So that is what we have calculated, because currently the current WACC is 14.9, but after we decided to issue debt, that has gone up to a different figure of 16.77. So let's see percentage increase. What is that? Because we will have to talk about that. That is this minus this divided by this. Yeah, new minus old divided by old. That's almost 13% increase. Wow. That is a lot. Yeah. The 13% increase. Yeah. And in absolute, if you want to say it in absolute, that will be just saying this minus this, whichever one you are comfortable talking about, because you have to also comment after the calculation. So we can talk about it and say the new debt and right issue has increased WACC from 14.9% to 16.77%. That is about 10% increase. That is the impact that you're asked to discuss, and it's no more than that. Yeah. So that is for the first part, the second part of the question. Now, let's look at the third part C. Very important. The part C is talking about us making a comment on what the discussion from those directors, what they've been talking about. If you look at the directors, if you have gone through the question, you see that the directors were actually talking about the impact or the expected impact of issuing a debt on the WACC and value of the company. Let's look at what they say. They say the directors believe that by using a mix of debt and equity, the WACC will be reduced, and as such, the value of the business will be increased. That is what the director said. The question wants us to now discuss this view, that the mix of debts will reduce WACC and increase the value of business. If you remember those theories that we looked at, there are three of them that we looked at. We looked at the traditional theory. We talked about the M&M, Modigliani and Miller, without tax, and Modigliani and Miller with tax. And what they want us to discuss here is quite consistent with what Modigliani with tax and slightly with traditional theory is talking about. But not with the Modigliani without tax. So there are only two theories that are aligned here. Because if you look at Modigliani M&M theory with tax, that truly agrees that if you keep increasing debt, and likewise the traditional theory, if you keep increasing debt, your WACC will reduce. And if your WACC is reducing, definitely the value of the business will go up. Because remember your perpetuity formula, the value of a business is equals to the cash flow divided by WACC. So if WACC is small, then the value will be higher. So that is the discussion that they want us to do. But if you look at it, that's not the case for this question, because we have moved from 14.9 to 16.77. So which means we have issued debt, however, our WACC has gone up. But there's a reason for that. Look at this. The cost of equity is 17.7. That is super high. Look at cost of debt, 5.3. So definitely this has actually reduced the WACC invariably, because if you have left it with only equity, then your WACC would have been about 17%. But you can see the WACC has gone down to 16.7. So the reason why the 16.7 is not lower than 14.9 that used to be our WACC is because the debt that we have issued, which is cheap, is just 8%. That is too small. Compare 8% to 92% of 17. Obviously, that's almost 100% equity. So for you to benefit from this cheap debt, you need to issue more debt and increase this percentage. Imagine if this had been, let's say 50%, just playing around this. Look at it. WACC has gone down to 11.55, right? So that is exactly what we are saying, that the reason why we have not practically seen the reduced WACC is because the amount of debt is too small. So we advise the company to issue more debt, at least in line with the traditional theory, until they get to a point where the debt has been maximized, and that is called the optimal point of gearing, where your WACC will be at the lowest point. So more debt needs to be issued. And that is what I've summarized in a small write-up for you here. So for C, so you can read through, and that is the summary. And that is it for this question. Remember, keep liking, keep sharing, and if you have any question, put your comment, reach out. I'm here to support you. All the best in your exams. Bye now.